examine the role of the G20 in addressing the 2008 global financial crisis. This case study will explore the G20's structure, actions, and the effectiveness of its response to the crisis, highlighting both its successes and the challenges it faced. The G20, a brief overview. The Group of 20 is an international forum for the governments and central bank governors from 19 countries and the European Union. It accounts for approximately 80% of the world's economic output and 2/3 of global population. Established in 1999, the G20's primary focus is international economic cooperation. The G20 operates through annual summits, ministerial meetings, and working groups. It aims to address global economic challenges, promote financial stability, and foster sustainable development. The 2008 global financial crisis, a turning point. The 2008 financial crisis, triggered by the collapse of the US housing market and the subsequent failure of major financial institutions, quickly spread across the globe. It resulted in a sharp decline in economic activity, rising unemployment, and financial instability. The crisis highlighted the interconnectedness of the global economy and the need for coordinated international action. The G20, with its broad representation of major economies, emerged as a key forum for addressing the crisis. The G20's response to the crisis. The G20 took several actions to mitigate the impact of crisis and stabilize the global economy. Coordinated fiscal stimulus. G20 countries agreed to inject trillions of dollars into their economies to stimulate demand and prevent a deeper recession. Financial regulatory reforms. They implemented new regulations to strengthen the financial system and prevent future crises. Increased resources for international financial institutions. They provided additional resources to the IMF and World Bank to support struggling economies. Improved cooperation on trade and investment. They committed to keeping markets open and resisting protectionist measures. Achievements and shortcomings. The G20's response to the crisis was largely considered a success. It helped to prevent a global depression and restore financial stability. However, there were also shortcomings. Unequal impact. The recovery was uneven, with some countries benefiting more than others. Developing countries in particular faced significant challenges. Lingering problems. The crisis exposed underlying structural weaknesses in the global economy, such as excessive debt and inequality, which remain unresolved. Implementation challenges. Some of the agreed upon reforms have been slow to implement or have faced resistance from vested interests. Discussion questions. Was the G20's response to the financial crisis effective? Why or why not? What were the strengths and weaknesses of the G20's approach? What lessons can we learn from the G20's experience in managing the crisis? How can the G20 be strengthened to better address future global economic challenges? What is the role of other actors, such as international organizations and civil society, in global economic governance? The G20 played a crucial role in managing the 2008 global financial crisis. Its coordinated response helped to avoid a deeper economic downturn and restore stability. However, the crisis also exposed the limitations of the G20 and the need for further reforms to strengthen global economic governance and address the root causes of financial instability.